Hello and welcome to today's Tax in 10 topic, IR35 off-payroll workers and the new rules operating from April 2020. My name is John Newell and I'm a Senior Manager at James Cooper Preston, specialising in business and employment taxes. This session gives pointers regarding what the new IR35 rules will mean for contractors, their hirers and the labour supply chain. Please note that the information is a headline only and if necessary you should seek specialist advice specific to your circumstances. So why do we have IR35? Fundamentally, these rules are required due to the different rates of national insurance contributions due when a worker is self-employed or an employee. For example, an employee earning £50,000 per year will pay about £5,000 of national insurance. Their employer will pay about £5,700 of national insurance, giving a total national insurance cost of £10,700. Compare this to a self-employed worker earning £50,000 per year. They will only pay about £3,900 of national insurance, and there is no employer's national insurance to pay. So for every worker earning £50,000 who could or should be an employee, the government are missing out on about £6,800 of uncollected national insurance. There are also some income tax savings which can be achieved by workers using corporate structures and a combination of dividends and salary, but these savings are only marginal when compared to the national insurance savings I've just mentioned. The off-payroll working rules, commonly known as IR35, ensure that individuals who work like employees pay broadly the same income tax and national insurance as employees, regardless of the structure they work through. The rules do not affect the genuinely self-employed. The rules have been with us since the year 2000, but HM Revenue and Customs believe that only 10% of those workers to which IR35 apply are currently implementing the rules. They anticipate that this non-compliance will lead to a loss of revenue of £1.3 billion a year by the year 2023. The new rules are designed to increase the level of IR35 compliance. A similar rule was applied to the public sector in 2017, and evidence suggests an estimated additional £550 million was collected in the first 12 months after this introduction. The new rules will be extended to the private sector from April 2020. So let's start by looking at who the new rules apply to. To be within the rules, a business must be medium or large. For incorporated businesses, this will mean passing 2 of 3 tests. Its turnover over 10.2 million, balance sheet gross assets of 5.2 million, more than 50 employees. For group companies, these limits apply to the whole group position. For unincorporated businesses, the rule is simplified and it's just turnover exceeding 10.2 million. If a business is not medium or large, it continues to operate IR35 as it did before. The new rules shift the emphasis of determining if the IR35 rules apply from the contractor to the end user client. Affected businesses must assess each and every off-payroll worker to determine if the off-payroll working rules apply. First, they will exclude fully contracted out services which involve labour. HMRC's guidelines give the example of a business carrying out window cleaning services. The cleaning service carrying out these services, taking full control of its staff and how the work will be carried out. It will not be necessary to assess each window cleaner in this instance. For any contract that is not part of a fully contracted out service, a business will need to assess if the IR35 rules apply. Once they have made their decision, they will pass the determination and the reason behind it to the worker and to the person or organisation that they contract with. If the business contracts with the worker's personal service company, the business becomes the deemed employer and must operate PAYE on payments made. If there is a series of intermediaries in the labour chain, the determination will pass down the labour chain until it reaches the entity that is paying the worker or the worker's personal service company. This entity then becomes the deemed employer and it must operate PAYE on the payments made. The worker has the right to appeal to the client if they believe that the determination is wrong. If received, the client has 45 days to respond to the appeal. Failure to respond will shift the requirement to operate PAYE to that client. There are a number of rules currently under consultation, so not yet final, that will pass a PAYE liability up the labour chain if the deemed employer doesn't or is unable to pay. It will therefore be important that those hiring contractors in extensive labour chains carry out due diligence on their service providers to ensure that the PAYE will be paid when and as appropriate. So in summary, those affected by the new rules will be medium or large businesses that must now assess the IR35 status of workers and possibly operate PAYE on payments to a worker's personal service company. Contractors working for medium or large businesses through a personal service company, as this intermediary will no longer be assessing the IR35 position. And agencies in a supply chain, if they are the entity that are paying fees to the worker's personal service company, as they will now have to operate PAYE. The actual rules for assessing the IR35 status hasn't changed. So we still, when assessing the employment status of a worker, look at a number of factors. It is important to note that what we are assessing is the notional contract that exists between an end user and the worker. This notional contract describing the actual working relationship with the worker. This is not necessarily the same as the written contract, which might not match the actual real-life relationship. Written contracts cannot always be relied upon to be factual. The main factors that we look at when assessing employment status are substitution, control, mutuality of obligations, financial risk, and integration. If a worker is able to send a substitute in their place and at their own expense, they are unlikely to be an employee, although reliance on this test is becoming difficult with recent court cases going against the worker. A worker who is fully controlled by the client is likely to be an employee, whereas a worker who is free to manage how, when, and where they will carry out the role will likely be self-employed. If the worker can financially benefit from their own skill and efficiencies and also be subject to financial penalty for ineffective work, or be required to make good errors in their own time and at their own expense, then they have financial risk and are unlikely to be an employee. A worker may be held out to be an employee of the business, hold a position in a firm, maybe have a business card or an internal number. The more integrated a worker is in the business, the more they start to look like the employee that they are working alongside. And finally, we have mutuality of obligations. If the client is not obliged to offer work and the worker is not obliged to accept work when offered, there can't be an employment. And recent case law has again confirmed this point. There are other minor points, but all factors will generally be looked at in the round. Some factors are definitely more weighty than others. These assessments are not straightforward, but there is potentially some help offered by HMRC on their website. They have the Check Employment Status for Tax tool, commonly known as CESS. This involves answering a series of questions in relation to a working relationship, and once completed, it will issue an employment status determination. HMRC have said that they will stand by the determination given by CESS if the questions are answered correctly and not in a way to give a desired outcome. It is worth noting, however, that CESS does not take into account the mutuality of obligation test, so may not give a definitive answer. So that concludes this discussion. If you would like to know more or wish to seek our specialist advice, then please contact me directly or visit our website at www.jamescooper.creston.co.uk. Thank you for listening.